Is your cryptocurrency actually dead? Or are you just waiting for a recovery that will never come? Last year alone, over 11 million crypto tokens went to zero. That's more than 30,000 failed projects every single day. Most didn't crash in a dramatic way. They simply disappeared. The crypto market has entered a phase of extreme attrition. Since 2021, more than half of all crypto projects tracked by major platforms have failed. Statistically, picking a random altcoin has become riskier than a coin toss. And last year marked a turning point. Around 86% of all crypto failures over the past 5 years happened in a single year, following a massive liquidation event where $19 billion in leveraged positions were wiped out within hours. Market volatility alone doesn't explain this scale of destruction. Between 2024 and 2025, token creation became fully automated. The number of crypto projects exploded, from around 400,000 in 2021 to more than 20 million by the end of 2025. Most had no real product, no development team, no revenue, no genuine use case. Many existed only long enough to attract short-term attention before liquidity vanished. Failure stopped being the exception. It became the default outcome. Technically, a crypto token can exist forever on a blockchain, but economic life is something else entirely. In practice, 3 things determine whether a crypto project is alive. First, trading activity. If a token has no trades for days, weeks, or months, it has effectively been abandoned. Without volume, there is no price discovery and no real exit. Second, exchange delistings. Once a token is removed from exchanges, liquidity usually disappears. Projects delisted from smaller platforms rarely recover. Third, rug pulls and fraud. In many cases, developers drain liquidity entirely. The token still exists, but its value is functionally zero. Some projects don't fully disappear. They become zombie assets, technically alive, economically irrelevant. They may still show market capitalizations in the hundreds of millions, while having almost no real liquidity. And this is where many investors are misled. A token can look valuable on price trackers, but collapse the moment someone tries to sell. Liquidity matters far more than market capitalization. As a rule of thumb, healthy projects maintain liquidity of 1 to 5% of market cap. Anything far below that is extreme risk. Developer activity is often cited as proof that a project is alive, but this signal is increasingly manipulated. Some projects simulate activity with trivial updates or copied code, creating the illusion of progress without substance. That's why volume, liquidity, and real development must be evaluated together. Hope is not a strategy. Crypto markets do not reward belief. They reward structure, liquidity, and sustained demand. The uncomfortable truth is simple. Most crypto projects die, and many were already dead long before investors were willing to admit it. In a market defined by overproduction and speculation, survival is determined by liquidity, volume, and market structure, not promises, roadmaps, or narratives. The market doesn't move on suddenly. It moves on quietly.